Good Fed day, everybody. How's everyone doing? Brock, Kevin, Arena, good morning. So, Fed has its hands full today. And anyone know why? How about because of this? There's your 10-year. Okay. Here's your 30-year. Good morning, Alexander, Amira. Yeah, look at that. So, I mean, we're on the verge of blowing out some divergences on different time frames, almost. So when I look around and I see higher rates, some's expected, really not killing the metals here. So that's one aspect of it. All right. Gold, up until today, has been acting better than silver, still is. In fact, we're on the verge, if you look at the gold silver ratio, of turning up. A pretty good signal is going to be closing back over the 68 level. So right here is the second higher low. This was the washout, right? Taking out major support. We failed here at 68 a couple times. Now we have moving averages, the 50-day up here, and we penetrate that. We could go to 76, and that'll imply gold outperformance of silver if that happens. Of course, if we roll down, that's another story. My last observation, well, second to last, is, finally getting a little bit of a red candle. To me, it looks like really 39.80 is going to have to hold on any breaks in the S&Ps if we're going to still go to 4,100 or so. And this is something that's lagging the move in rates the last few days. So rates continue to make new highs and the yen has not. Okay, US dollar yen has not made a new high yet since last week. And rates have been surging to new highs. I'd look for maybe one more high up towards 109.50 after the Fed. I'm not doing anything until after the Fed. And I'd be looking to fade the yen up there if we got to 109.09. And a funny thing happened yesterday afternoon. I was looking at this. All right, it's a real nice wedge in USD Canada. And we've had 3 months of divergence. And then I went to the chart of the day, and there's Blake. Blake, I promise I saw this before you put out the chart of the day, but kindred spirits. Take a look at Blake's chart of the day. It has a pretty similar look, but with crude starting to not make new highs every day. In fact, starting to look like it could roll over. The dollar on the verge of closing over 92. Canada looks good. I'd look for maybe one more decline here. This looks like I almost bought it yesterday. I figured, well, you want to buy it at 24. What's the difference if you pay 40? But if you can see this, here's one, which was already diverging, and here's two. And we get one more shot down. I think it's a decent spec, on a bottom pick, you don't put a lot of leverage on, and you give it breathing room in case it takes some time to develop. But take a look at Blake's chart of the day yesterday, and I guess we both saw the same thing, Blake, in USD CAD. And I have a question for you, because this always used to be hard for me, and I'm sure it's hard for our viewers, our attendees, our members, is that I took a loss when I was positive up here, I thought we were going to end up with a breakout after that big rally that was a straight line move, and then it just gave up the ghost. And my question for you, Blake, and I think I know the answer is, earlier in my career, if I would, take a loss in a particular instrument, I would, kind of have the just, would move along and look at something else, and would have a hard time recommitting to the same trade because, I'd taken a loss in it. And instead, later on when you mature, you go, well, you know what? Sometimes you have to be the wrong way in the market and you're early. It doesn't mean that your idea was off. It was just a little bit of the timing was off. So the bigger idea, the macro idea, was still good. And I know for you, it's probably not an issue, Blake, but was it ever, after you take a loss in a particular instrument, that you would kind of move away from it and start looking at other things?
It's a great question, Dale, and that actually has been something that has made it easier for me to deal with, especially over the last several weeks that I've made a transition from trading for a firm versus trading my own money again. Is I know I'm early in my ideas, and that's why I tend to piece together positions. Like I try to get a core position. It's easier to do it with my own money and with smaller amounts versus trading a
Yeah.
couple million in currency and realize I've been wrong for a couple of days. It's like, oh my gosh, I just lost $30,000 because I was just trying to be cutesy. And you have to be a little bit more accurate in your timing in order to do that with size. You know what I mean?
Yeah.
And so trading my own money, it's a lot easier. I can establish a smaller position and kind of sit in it for a while and say, okay, I know I typically am a little early in my decisions here. Not always, but I can be. And so if I want to commit to an idea, I can do it in smaller size until I, see the actual, the big reversal coming. And all of that happens a lot really in, that happens a lot when you're trying to make a stance in a big reversal.
Yeah.
What would be in a big reversal scenario. And today would be one of those situations, Dale, where we could actually get a pretty good reversal in the market. But I don't think we can really commit to it and bet on it right at this moment,
Yeah, maybe after Powell and see what the action is
Yeah, we
across
totally
the
have to
board.
wait till after Powell because there are a lot of divergences in the markets right now, Dale,
Yeah.
and I'll tell you, it's very one of the things that you'll notice here, I think, in the markets is that even though we're seeing a reversal we're seeing yields really push up the market, push down the market, well, depending on what you're trading at the moment, but if you're watching, yields break out and bonds and treasuries are just getting demolished. As we talked about yesterday, the bond market is making lower lows and lower highs. Yields are making higher lows and higher highs. And now that bond traders are faced with the idea that the Fed is going to meet today and might actually have to be a little bit more hawkish, because let's think about it from a bond trader's point of view at this moment. What could stop the bond market from going down at this point? Because let's think about this. Is the Fed at this moment, are they worried about the rise in yields at this moment? Based on that interview that we had with, was it a Wall Street Journal interview, webinar, go-to meeting that Powell did, was a week and a half, 2 weeks ago?
Oh yeah, during what used to be Humphrey Hawkins. Yeah.
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 No, it wasn't that. It was like a business roundtable with the Wall Street Journal or something. Anyway,
Oh, okay.
he wasn't concerned with the rise in yields, and the stock market actually came under pressure that day, right?
Yeah.
So I don't know if he's going to voice any concerns about the rise in yields. So at this point in time, what could alter, bonds really? What could get bonds bouncing at this point? I don't.
Yeah. I don't
Unless
I don't know what he could say to make that happen.
no,
You
because he's
think
not going
that
to
if
do any
he's
type of. Go
go
ahead.
ahead.
No, I was just
Oh
going to say he's not going to do any yield curve control at this point.
yeah, too early.
It's way too early as far as everybody's concerned. So, I don't see any way that yields don't go higher. But usually, when I feel that way, there's something's going to happen to make it happen. But I guess the point I'm trying to make here is it's squeezing, people out of anybody who's trying to play a bond bounce, like because you had, was it Dave Tepper on CNBC last week?
Yeah.
Saying that you should be able to buy bonds here, right?
Yeah.
And how many retail last week
Yeah, we got the bounce and here we
bounced from
are.
the 127% extension and are playing it to the long side. Now bonds are oversold, and I'm not saying that they can't continue lower. It's dangerous trying to play here technically.
It's one of the only markets, Blake, taking out the COVID crash lows it's one of the only complexes taking out the April lows, the crash lows in
yeah, it's a great point, Dale.
Yeah,
and
the only one.
Yeah, it's and there the bond market goes. Now here's the thing. The dollar's not convinced with the bond market move. I mean, the dollars, you can see the dollars actually responding a little bit, where we're seeing, as you would expect, the commodity currencies are getting hit a little bit worse. But I mean, you look at the Aussie. I mean, we were lower last week. We slid down towards yesterday's support right at 77 cents. Right?
Sideways for a week.
Yeah, you look at the bias chart this is from yesterday that we put together. 77 cents as being support. Yeah, I mean, here we are just on support, and it's not like we're seeing a big move. Even the yield sensitive currencies like the dollar Swiss, I mean, it's higher, but it's not higher. I mean, dollar yen is firmed up right up against really key resistance. As you guys know, if you read the edge chart of the edge chart of the day, or our blog, I mean, we're brushing up against a multi-year trend line here. It's going to take the FOMC to break this one out in all actuality. But I think at this point, the market is getting a little nervous that the Fed chairman may not express a lot of concerns about yields. And one of the things that I think we have to be a little bit worried about is if he actually sounds hawkish, right? And this is where the counterintuitive conventional wisdom kind of, you have to throw it out the window today, is if the Fed chairman actually sounds hawkish, that's bearish for equities and it's bullish for the dollar, because you have to imagine that if he sounds more hawkish than the market expects, what's the market expecting, Dale? They're expecting him to say, he's going to keep rates low forever, and it's the same old, right?
Yeah,
right.
To put it on a tape recorder.
Yeah, exactly. We're still, and I have to say, more than likely, that's what we're going to get.
He did get what he wanted with going big on COVID relief. I mean, he was asking for that, begging for it almost for months. So you would think he would have a comment now that it passed, this COVID relief, that, Congress did what both him and Yellen were advocating. So how
Yeah,
does
yeah,
that
yeah.
affect his policy now?
Right, right. Yeah. So he did get the fiscal relief
Right.
or fiscal help that he has been begging for.
Yeah.
But now will he recognize that inflation expectations are rising? Is the economy, you know, um,
Overheating. Could it
stabilizing?
overheat?
Yeah, will it overheat? But
Yeah.
if he sounds just a smidge more hawkish, that's when you're going to start to see the market anticipate that they will start to respond to yields in the coming months, and that the response to yields will come in. It's going to come in one of two flavors. And this is where your camp might differ from somebody else's camp, and this is what makes a market, is that one of two things are going to happen. The Fed is going to start tapering at some point and suggesting that they're going to taper as yields continue to go higher. So the market starts forcing the hand of the Fed in a way, or we're one step closer to some sort of yield curve control as they try to suppress the long end of the bond market. And the day that we get that, you just sell dollars. That's
I don't
it.
know if you listened to the interview with Mark yesterday, Blake, but his candidates for the first countries to begin to taper, do less QE, are Norway and Canada.
Yeah, and I mean, if you look at like the Canadian employment that happened this last weekend, that would be I could see his reasoning there, and Stelios would give you every reason in the book for Norway to be the first to normalize. And Stelios, didn't Norway raise rates when everybody else was cutting?
Yep, I think they did it twice as well, if I recall.
Yeah.
2 or 3 years ago.
What's that?
2 or 3 years ago, they raised twice. Yeah.
Yeah, and I mean that could happen again, but U.S. dollar, Norwegian krona is actually holding up relatively well in the face of everything, and I mean, if you're looking at the, just from the beginning of 2021, and look at how it's held up in the face of stronger crude oil and stronger equity markets globally, as the DAX hits all-time highs, the S&P, the Nasdaq. It's surprising that the US dollar Norwegian krona is not below 8 right now, isn't it?
Yep, that's
Nice
one of the main reasons why I cut all my exposure to it, and I want to add at higher levels.
Yeah. So I'm actually hoping that we will see the US dollar Norwegian krona scream up towards 9, somewhere up here, because this is going to be the 38% retracement. You can see, ooh, I didn't want to move that, actually. I'm going to grab the wrong thing here. I wanted to grab the blue line. Let's see. Yeah, right there.
Oh, yeah. Gross said that the Fed is engaging in another version of Operation Twist, which he's going to bring in Chubby Checker. I don't know if you guys remember. He invented the twist, Chubby Checker. All right, that's Operation Twist to me, buddy.
All right. Well,
I'd need a back operation if I tried it. Anyway, so.
Well, today's going to be an exciting day with the Fed. I think we have, we're going to have a lot to unpack, but I think that, and you guys might have seen it earlier, but I'm going to put this up here because I've made a stink about it the last couple of days, even with the, with the daily roundup, our webinar for ForexAnalytix subscribers. That, and I've talked, kind of ad nauseum about Bitcoin, and I'm going to say it again. Bitcoin is the riskiest asset on the planet, and it's not. You and I could disagree or agree on how risky it is, from an actual investment standpoint, but from a instrument standpoint, it is an aggressive and risky bet in the markets, kind of like the equivalent of Netflix or,
Tesla.
right? We can argue about the validity of Bitcoin as an investment vehicle, but from an market attitude standpoint, it is a risky bet. Therefore, if Bitcoin actually reverses, that would signal to me that we have risk off in the market because of the way it is regarded as a risky asset. Not because, I'm not going to be the person that argues with you at this stage that Bitcoin's going to 1 million or Bitcoin's going to 0. You guys can make those, assumptions for yourself. But the way it's traded and the way it's regarded as an investment vehicle at this moment is an extremely risky asset. So therefore, it's going to move up with risky assets and down with risky assets in a magnified way or an exaggerated way is the way I should put that. So that's why I'm keeping a really close eye on Bitcoin, especially if we break through 52,500. Okay. So Stelio, Steve, good morning, guys. How are you?
Good morning.
Good morning, everybody. Happy Fed Day. I said this yesterday. I would love for Powell to show some kind of a hawkish sign, but I just don't see he doesn't have any incentive to do that. He knows that any hawkish sign and the markets, the equity markets are going to go lower, and they don't want that. So unfortunately, I think he's going to give us nothing. The question is it enough for the markets to keep going? Like you said yesterday, Blake, that's a big question. But I don't think he's going to give us anything new, unfortunately.
I don't think he is either. So, and I believe that that's going to keep the markets kind of where they're at right here. I think the market's getting a little nervous because, we're stretched. I mean, but by every, measure and calculation. I mean, you look at one of my most basic indicators, Steve, Stelios, Dale, what my most basic indicators is for the markets?
Common sense.
No, but good. That's a good one. But is the distance from the 200-day moving average that we are.
Oh, yeah.
If you take this is the S&P, not on a log scale, I'm gonna keep it off of a log scale. But when you get so far away from the 200-day moving average, that's when we call it the old rubber band of stretching, right? So once you stretch too far away from the 200-day moving average, you'll get a snapback. And this is obviously the COVID move. So, I mean, you can see we are stretching. I mean, when we bounced the summer of this last year, that's how far we got away. Ooh, shoot, and you can
now
see
look at it.
Same distance.
Yeah. One of the largest, except the COVID.
Yeah, aside from the COVID. So we are stretched. That's and again, this is something I've done for, if you guys have been listening to me for over 10 years, you've seen me do that on numerous occasions. When you get that far away from the 200-day moving average, you gotta be careful. It's not the time that you really want to be, aggressively buying. Now we could get a blow off top. I mean, we could end up, going to 5,000, then straight down to 3,000 in the course of the next week. If he does some sort of yield curve control, but I doubt that's going to happen.
Remember, you said Andre saw Head and Shoulders in S&Ps before it made new highs, and that internal one, but it measured 4,100, and I'm hearing a lot of that number coming up, 41 to 42, maybe in April.
Well, Steve's about ready to give you guys all explanations on how the S&P can actually reach 10,000 tomorrow, or actually next month, right, Steve?
Absolutely.
Well,
Why
you
not?
know what? Dale's hearing 4,100 in the S&P, how we could possibly get there. I mean, can you really deny that. I mean, how about if
In the era that people have started bidding actual money to buy tweets, you know,
Yeah,
there
I
is no
can't believe
there
that.
there is no price that doesn't or does at the same time make sense anymore.
I've got tweets from 10 years ago that I'm willing to sell to you guys.
Me too.
10 years
Whoever
ago.
wants to bid,
Yeah.
I'm a cheap bastard. I'm going to sell them cheap.
Going once, going twice,
Yeah.
sold at a nickel.
I mean, it's crazy, right? I mean, this is a world of access. I know we've talked a lot about it, but man, it's crazy. Digital art. I mean, I love
Yeah.
art. My wife and I, that's one of our guilty pleasures, I think, is when, whenever we travel, we pick up art different places. I couldn't imagine like not having art that I can't physically hold, touch, see, appreciate in person. I don't get that. I don't get it.
What's the point, right? I don't get it. What's the point?
What is the point?
I don't get so much nowadays. I feel
DJ
like
asked when's ForexAnalytix releasing their NFTs. Yeah, I mean, obviously, Steve, you need to get on that with the developers.
Absolutely.
Can you do that like tomorrow? So, hey, what do you?
The idea on non-fungible tokens, once again, like the whole idea of cryptocurrencies and the blockchain technology, in my opinion, irrespective of the ridiculous of the thing, has its merit and can end up being used for useful things, right? I mean, think about it. Instead of having to go through bureaucratic processes, in the future we might be able to put in a non-fungible token in your house. So instead of having to go through like the bureaucracy of selling it, you can sell it via a non-fungible token, right? But the idea that stuff that have no collector's value, like a simple picture or whatever, can have like future value, it's so ridiculous. But it shows in what part, in what stage of the overall mania we're currently in.
Right, exactly. Well, hey, let's talk a little bit about what's happening today. But gosh, that's a conversation that we'll probably spend a whole Friday morning, as the market winds down for the week, talking about. And maybe that's a discussion for this Friday. But I want to point out the Nasdaq, which is reversed at the 618 retracement, as we pointed out yesterday on the daily roundup webinar. And it's key. And the thing about higher yields is when yields break out like they are, the Nasdaq is the market that's going to get hit the worst. And if you look at like the Dow's, I think it's probably up this morning. That's where you start, you get value over risk, right? So over growth. Like here's an example where the Nasdaq's coming down, and the Nasdaq has been underperforming literally for the last several weeks. And you look at, there's the Nasdaq, and then take a look at the Dow. Here's the Dow. The Dow's at all-time highs. Why are we diverging like that? Yeah. Why do you see that divergence? It's because bond yields are rallying, and as yields rally, it's suppressing risk and growth, and it's bidding up value, and that's why you're seeing that divergence. So, and I'll say this again, and I've said this for the last several weeks: if you want to play the short side of the equity markets, play the Nasdaq, right?
Yeah.
Play the Nasdaq on the short side.
Although people shouldn't forget, Blake, that this rotation is just the first safety valve, meaning that when people start getting worried about let's say valuations, they will rotate to value stocks. But if things really start tumbling, they'll get rid of everything at the same time.
There's no hiding. You got it. Hey, Forex Gal asked just before we go for me to take a look at the dollar index. We have a bull flag formation, but yesterday this is for the ForexAnalytix subscribers. If you're a member of ForexAnalytix and you're listening in to our webinar in 45 minutes. Daily, you knew that this was resistance yesterday, and it still is resistance now, but we hit it yesterday, came off of it. We are in a bull flag pattern. And while we're above 91.40, the risk is higher. And if
We
the
just
dollar
got building
index,
permits, by the way. A little bit worse, but you know, nothing that will move the market for sure, especially ahead of the Fed.
got it. Okay. Thank you, Steve. And you know, we have our guest, and I don't want to take away from her time. So
Michelle's not here yet, but
okay. So one of the most lopsided, you know, positions out there right now would be, you know, the short dollar trade. So if
she is here. All right.
What's that?
She is here. I just had her name.
Oh, okay. So
now I got her.
Okay.
Go
So you got to watch the dollar. If equities continue to feel pressure, or you start to see yields continue to break higher, the dollar is probably the place that you're going to see in currencies. You're going to see it move, and I'd probably focus my attention more on, you know, the commodity currencies or the emerging market currencies. So those are going to be the ones that probably see more downside than, let's say, the euro or the sterling. So anyway, all right. Well, Steve, Stelia, sorry I never even gave you the charts today.
No problem.
That's fine, man.
All right. Hey, I just want to mention those of you that are not ForexAnalytix subscribers, you know, check it out. It's only $1 to try it out. $1 for 10 days. Download the mobile app when you do it, because this way you'll have all of our analysis in your hands. And then visit our sponsor, which is Pepperstone Securities. They're one of the largest FX brokers in the world. And if you want to try to get ForexAnalytix for free for a few months, open an account with them. And you have to do it through this link, because that's what connects ForexAnalytix to Pepperstone Securities, our internal system. So thank you guys for all your support. Dale, have a great interview today. And
Michelle's one of the best intermarket analysts I know.
Awesome.
Inter.
Looking forward to hearing her. And then for those of you that are ForexAnalytix subscribers, I'll see you in about 45 minutes with Steve and Stelios for the Morning Edge. See you there.
Good hunting, Blake. Hello, Michelle. Welcome back.
Hello, can you hear me?
I can hear you. And if you could share your screen, I know you're on a tight schedule.
Okay.
And I'm not going to interrupt you as much as usual, because I want to hear all the pearls you have for us today. So,
all right, first of all, I'm going to start the video. Okay.
the video is for your, is the camera. You want us, you do the share screen.
Yeah, got it.
All right. So Michelle is being interviewed everywhere. She's on Fox News. They interview her in China. She has an interview right after this on CoinDesk. So there's a reason why people invite Michelle to, you know, whatever their format is because of her insights into the market. So take it away, my trading warrior sister.
Hey, Dale. Thank you. Thank you for that lovely introduction.
Yeah, okay. You're very well deserved, not patronizing. It's just the truth. Go ahead.
All right. Well, I hope I can live up to it.
What are we looking at? The dysfunctional family here?
Well, actually, if you're looking at the family here, they look rather functional, don't they?
Yeah.
So this is a market that's very skittish, obviously, because of this new fear of the rising yields and what Powell's going to do or is not powerful to do. And then what's going to happen to the market as a result. And that's why I think that you're seeing the modern family very strong, because they're functioning more on a factor of optimism for the economy coming back and coming back really strong. That's why the family is the family, because the family really represents the inside of the economy. The only one that there's two members that have been relatively struggling. And when I say relatively, they're still in strong bullish phases. And that would be semiconductors and biotechnology. So what you're seeing here is retail, which is somewhat influenced, by the way, by GameStop. So that's not really giving us a fresher read as we would have liked just pure brick and mortar. But nonetheless, you can see right here that it's really inside last week at the upper end at this point. Doesn't really get dicey unless it starts to break down under last week's low, which I can barely see here against this black screen. Let me
It's like
see.
76.80 about.
Yeah,
there, Michelle.
76.80. So right now we're trading at 91.55, and XRT looks like it's coming in. Well, right now it's trading at around 91. So there's that. But, you know, it has room, like you just said, all the way down there before we start to get nervous about it. Here's IYT, which we know went and made a new high on Monday and now is sitting back in the range of last week. But again, doesn't really get dicey until it breaks about 217. Biotech actually started to come back a little bit after it had this big correction, but it doesn't really get interesting until it takes out 160. And if we break down under 150, then I would say, okay, that looks pretty ominous. These 50-day moving averages here coming in could be the key support. And even
any reason why biotech would be under more pressure than the other groups with interest rate pressures? You know, especially in this age of vaccines, why biotech looks to be probably the weakest chart you have up there.
Right. Well, I think a lot of it has to do with the fact that all of the news about the vaccines were sort of in the market. Yesterday, Moderna actually went up. But these companies like Johnson & Johnson and Pfizer and even Moderna, even though it had a bit of a pop yesterday, that's like yesterday's news. So then you have these incredible fluctuations among some of the other drug companies, successful trial for something, and you see a particular drug company go up 70%, let's say overnight. And
are
vice
you,
versa.
Michelle, are you going to get the vaccine? Are you going to accept the vaccine?
I'm on the waiting list. New Mexico has given out a lot, but Keith and I are both on the waiting list, and we haven't heard anything yet. But yes, I will, for the very simple reason is I want to travel.
Okay. Yeah, a lot of people feel that way.
That's the only reason.
Okay.
Yeah.
All right. Okay. Because I mean, we're not there yet, but you think it's going to probably go that way to get on an airplane, especially internationally. You'll need like a vaccine passport, right?
Exactly. And international is not even what I'm thinking about. I just like to get to New York to see my mother, who I haven't seen in a really long time.
Oh, gosh. Okay. I hope they move you up on the list, and I'm going to call New Mexico after the close today. All right, Michelle.
So getting back here, so just really, the semiconductors also have struggled. So interesting about the semiconductors because there is actually a legitimate chip shortage from Taiwan because of environmental conditions, drought, like they haven't seen in decades, since they are the major makers of chips. That's part of the drought situation. There's been some.
Why would a drought cause a shortage? What's the
They use
input?
water. They use water.
Oh, okay.
Yeah, they use water to actually make the chip. And what's also interesting is that New Mexico and Arizona in the United States are two states that are high up in terms of chip makers, and they're two of the least water states around. So I thought that was kind of bizarre.
Yeah, I mean, it's such a turnaround from, the normal narrative in chips is that it's been commoditized and there's billions of them. And boy, have things changed in a year.
Right. But now what happens is you have innovative technology that other companies are trying to come out with as a result. Like, for example, NVIDIA is trying to create chips through other types of mining, cryptocurrency mining. For its gaming part of its business. So there'll be companies who will try to work around, but right now this is something to keep an eye on, although we're not seeing it really in terms of new highs. It's not going parabolic or anything, but it's certainly something to be aware of. And of course, it may not even be bullish for the companies ultimately, because if they have to raise prices because of a shortage. So that's something else to be looking out. Like, for example, people have said to me, with all this food inflation, is it a good time to buy General Mills? And no, not really. I mean, General Mills as a stock has done okay because of the overall market, but if food prices have to go up, and
there goes their margin.
Exactly. So it's always something to be aware of.
I know you're on a tight schedule, and I want to acknowledge it. You're one of the first guests that came in, a couple of years ago talking about commodity inflation featuring sugar. before anyone, before the big move in silver and everything, you were bullish commodities. We've had a tremendous run, and I just want to validate that you were one of the first ones to come in and were ahead of the curve about commodity inflation, bull markets happening there. Do you want to give us an update on those?
Sure,
before
let's
you
take
go?
absolutely. Well, I just want to mention something here about transportation
Okay.
and banks, because
Okay.
you can see transportation went on so far early in the week to make a new high, and now obviously has come off with the rest of the market. But if you want to understand what's happening here, people cannot be calling a top at these levels. The only thing that's really looking ominous, of course, all is tied to the rates and the junk bonds, which right now have broken down. Let's show you what that looks like, because this is really what helped me determine that the market was going to crash last year before the COVID news really hit the market, was that these junk bonds, which had been what I call the Fed playground, were actually starting to sell off along with the high corporate grade bonds before the market did. And now you can see this is starting to get hit again a little bit, but on a longer term chart, we're here above the 200-week moving average. It never was able to clear, this is the monthly chart, was never able to clear the 80 months. So we haven't had any major reversal in terms of a long-term reversal of trend. But on a shorter term, on a 50-week, a 200-week moving average, we're still doing okay. So this is what I would watch here. While the market is still holding up near highs, if this holds up, if the bond buying program comes in strong, then I would say that right now the market still looks really healthy. If this breaks down, and I like to really bring it down to one instrument because it makes it so much more sensical, is that if this breaks down, I think it would be really hard to support these high prices that we've seen.
Like under 107 for that junk. What's the symbol?
Exactly.
JNK?
JNK, 107. Yeah, really, right. 107.
Maybe you could answer this question, Michelle. And I know that, now I know because you've showed me, but treasuries led the way down, right? And you and I were trained that treasuries compared to corporate and junk were the flight to quality. So can you explain why the quality has been the one bond market that has taken out the COVID low, the April low? The 30-year and 10-year have done that, while these are just starting to roll over. Why the extreme weakness in treasuries compared to junk and corporate?
Because of the yields. Well, you're talking about like the high grade bonds, or you're talking about the actual interest rate?
I'm talking about treasuries, like the 30-year bond and
like the TLTs.
Yeah, I mean they took out April lows.
Yeah, because of inflation fears. This is all reflecting the inflation fears right here, and which is so funny in a sense. It's so funny to me because you just mentioned, I've been talking about the potential for inflation for over a year now, since really I started December 2019, focused on the sugar market in particular, but not just the sugar market. I said this was going to be a food-driven inflationary environment. And what's so interesting is that of all of the different areas that the Fed looks at to measure inflation, food is an exclusion. So now all of a sudden people are catching on because of other things like industrial metals, but really oil is one of the bigger factors that they look at in terms of inflation numbers. And oil has gone up, but certainly not to any inflationary indicators. So right now, the inflation anticipation that I had was a reality, but with these yields coming off so much, that's now saying, well, gee, what is going to really make this inflation go out of control? And right now we have the dollar has bounced a little bit. Obviously, you can see the yields here are something that has bounced a little bit. The junk bonds, that's why I like to show it, because that's where people will go. They'll buy the high risk companies because they pay the most yields, are also struggling here.
They never learned the higher the yield, the higher the risk, did they?
Exactly. So when you look at the TLTs and it's coming in even lower, you can see it's coming in at 135.09, which takes out this low right here. So we're getting another gap lower here. Take a look at this. You want to talk about a trend. This is the 200-week moving average, which comes in again with a gap under this today.
Oh, okay.
Okay, and then also here is the 80-month moving average, which the yields have been, strong for a long time, but they took out the 80-month moving average after a brief dip below with all the Fed talk about raising rates in 2018. Remember that?
Yep.
Since then, they've been over this 80-month, and now here is 131.99. So if we break down, this is what I would be looking at around 132 as the next level of potential support. But let's take a look at these food commodities while we have some time.
So, I was thinking before you said that, I know you only have 5 minutes, but, when you were talking about these things, it was contrarian, right? A bottom in commodities. Everyone was still talking about deflation back then. And now it's been fully embraced, the reflation trade, everything. So perhaps now with what's happening with maybe the dollar and rates, we get a breather, which is going to create great buying opportunities in these commodities. What do you think?
I think that, yes, I would certainly, there's a couple of factors for food to watch because it's not just about the dollar and it's not just about the yields.
Yeah,
it's also about the weather, as we know. And so when you're taking a look at sugar right here, sugar is somewhat tied to oil as well, but sugar started making a move higher long before oil did. You can see that we started buying sugar here. We got out, obviously, and we've been long now sugar really pretty much since November. Well, it started in July. We added more in November. And now we've already taken some profits. But if you look at this trend here, this is why I love these 80-month moving averages. So I saw the move up to the 80-month moving average. But as much as I have been bullish on the inflation theory, I have to say we've run into some pretty serious resistance here. So while everybody's running for the exits thinking that there's going to be inflation, I'm thinking now that the anticipation of inflation may have been greater than the actual event of real inflation, unless I start to see these prices breaking out here, because that'll tell me sugar as my lead indicator for inflation long before anything else will tell me, maybe not so much. But if we take a look at corn, corn right now is still holding very strong. This is all weather related. Argentina, Brazil, and even in the United States. If we take a look at soybeans, and I'm looking at this through the ETFs, by the way, not the futures.
Right.
Also holding up really strong, really strong. This broke out over the 80 months. So soybeans had been underneath the 80-month moving average, which takes you about 6 years back. So it's a business cycle for years, since like 2012. That's a huge reversal. So this food-related inflation is what I'm still keeping an eye on, unless, of course, environmental conditions change. But there's been food hoarding. There's been supply chain disruption. There's been environmental conditions with drought. And then on top of that, you have the situation here where in the United States, there's been some weather problems too, and we're not even in the drought period yet for the United States. So this is something. So if you look at gold, of course, you say what inflation? Well, although gold is now looks like maybe it's bottom, we actually are long a little bit of GDX. We actually got in
32.
down here because the risk was so tight. We've already taken a little bit of profit, and we've bought some silver, which we've been in and out of for quite some time. We just got back into it at a little bit higher level, not much. We're long at 24.30. It's trading, it's coming in 24.10 and 11. But this too, we're really keeping an eye on here to hold up. If the metals start to move up, then maybe I would be more convinced about the inflation theory than just the food. And also, like I said, if we get back to the TLTs, this fear of inflation that's showing up in the yields is interesting, because I cannot wait to see what Powell does today. He may have nothing to say about Operation Twist, but that would be a real sigh of a relief for the market here right now.
Yeah,
So
Chubby Checker is going to be with him on stage.
Exactly.
I knew you'd remember. Anyway, I know you're running on a tight schedule. I want people to know, besides how to follow you on Twitter at Market Minute, how they can get to your website and follow your great work, Michelle.
Well, thank you. Market Gauge is our website. We do write a blog every day called Mish's Market Minute Daily, which is posted on Twitter at Market Minute. Market Gauge is the website. I don't know if I said Market Minute or not. It's still early.
You said Market Gauge.
I said
did.
Market Gauge. Okay, good.
Yeah.
At Market Minute on Twitter, and I'm on Instagram. I do morning stories on Instagram where I talk a little bit about the market, and I often give a tip, a trade, which so far has worked out really well. So if you can go to Instagram as well, and that's Mish Schneider there.
Okay. My trading warrior sister, and I kept you on schedule. And
Yes, thank you.
and I really appreciate you being here. I'll get a hold of you to set up the next cycle. Good hunting, Michelle. And I
Thank
hope you
you.
get your vaccine and you're able to embrace your mom. Again, I know, you know, that's really the toughest part of this whole thing because, you know, love always wins, Michelle. It's not about money. Love always wins. So
Absolutely.
thank you so much for giving us some of your time and your interesting views on the markets today, my friend.
Thank you, Dale, very, very much.
Okay. Thank you, Michelle. Everyone, that's it. That's a wrap for us today. Good hunting. We'll see everyone tomorrow. Remember, don't just count your commodities, your bushels, your bonds, count your blessings, and that'll be a wrap. Thank you. You're very welcome, Brock. People are thanking you, Michelle.
Thank
Adios.
you.
Yeah, adios, everyone.